Alphabet's earnings, and more precisely, the market's reaction to them, show that booming cloud growth just isn't enough if it comes with an even bigger AI bill. So both Alphabet and Tesla sold off yesterday in the after hours trading, and that despite delivering strong quarterly results. In Alphabet's case, free cash flow turned negative, screaming that the additional AI spending that they announced yesterday will have to be financed through debt and equity issuance. And with borrowing costs moving higher these days, funding these massive investment plans is becoming increasingly expensive. So welcome to Swissquote's Daily Market Talk. It's Thursday, 23rd of July. I'm İpek Özkardeşkaya. We will talk about what emotions the first set of big technology earnings triggered yesterday across the global financial markets and what's in store for central banks. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So I'm not going to beat around the bush. The first earnings from the big technology companies came in strong, but the spending was even stronger, and that made some investors feel tense and others relieved. Well, in the case of big technology, it was rather tense because Tesla reported a 23% revenue rise in the second quarter of this year compared to the same time last year when the revenue had taken a dip, remember, due to some political controversies around Elon Musk. But this time around, the record vehicle sales brought in money, but AI spending also ate into the margins. So the operating margin of Tesla fell from 4.1% to 1.4% only. The company reiterated plans to spend around 25 to 26 billion US dollars in capex this year on AI infrastructure, robo-taxis, Optimus robots, and custom chips. And investors did not like what they heard and sent the shares down by 4% in the after-hours trading. Over in Alphabet, the picture was pretty much the same. Google parent Alphabet reported strong numbers, a 24% rise in total sales to near 120 billion US dollars. The operating profit rose 34% to over 40 billion US dollars, and this is the big number. The cloud business revenue soared 82%, as well above the 63% cloud growth that the company reported in the first quarter. It somehow came to support the idea that Google is rightfully investing in its AI infrastructure because the business is growing and it is growing fast. Alas, what was really interesting is that even with these stellar results, investors refused to come back on board as the company raised its full-year AI spending plans by 15 billion US dollars to 195 to 205 billion US dollar range, while its free cash flow turned negative. Yes, Alphabet's free cash flow turned negative in the second quarter of this year. In other words, the company has burned all of its cash and the extra spending will have to rely on stock and debt sales. And unfortunately, the rising interest rate expectations make that cake quite unappetizing for investors. So, despite an 82% growth in cloud sales, a metric that would excite the hell out of investors a year ago, while Alphabet shares sold off 3% in the after-hours trading. So the knee-jerk reaction to Alphabet earnings yesterday sets the tone for the upcoming big technology earnings down the road. Investors will indeed going to be more focused on mounting costs of AI ambition rather than the revenue beats. They don't want more spending from the big technology companies, and that even though that spending helps boosting revenue and prevents a company like Alphabet from falling behind the AI race. On the other side, the big technology perhaps sees this as a short-term pain for long-term gain, but at the end of the day, investors say the last word. But as I was predicting yesterday, the higher spending outlook from Alphabet has echoed positively across the Asian chip makers, as that money will directly flow into the chip makers' pockets. And here I will bring up again this impressive chart showing the free cash flow flowing from the pockets of big technology companies right into the pockets of companies that are selling chips to these big technology companies. So no wonder the Korean Kospi Index, which is heavy in chip makers, is up by 3.77% at the time I'm talking here this morning. The Nikkei is up also despite the rising pressure on the yields front, while TSMC in Taiwan is actually having quite a hard time this morning catching a bit, perhaps as investors are getting increasingly uncomfortable with pressure from Washington to manufacture advanced semiconductors in the United States, a move that will obviously increase costs and squeeze margins at TSMC. Overall, more spending announcements in the coming days and weeks could eventually throw a floor under the chip stock sell-off that we saw over the past weeks, but the downside correction in big technology valuations looks set to continue. Today, Intel will release a second quarter earnings after the closing bell in the US. I'm looking for strong results, strong guidance, and potentially a positive market reaction to Intel's results as the company sits in the right side of the table among those who actually amass the big technologies money into their own pockets right now. Zooming out though, the global macroeconomic picture isn't looking any better today than it was a few days ago. Houthis reportedly targeted two Saudi Arabian tankers in the Red Sea in an effort to stop the country's oil exports from the Yanbu port as the traffic in the Strait of Hormuz remains near standstill as the US and Iran continues to exchange attacks and threats. So the situation is not looking any better. US crude spiked past the $90 per barrel level yesterday, while Brent crude soared past the $95 per barrel and is consolidating there today. That's around 36% higher than the July dip. And rising oil prices fuel inflation expectations and push yields higher globally. The US 2-year yield that best captures the Fed expectations advanced to 4.30% level, a fresh high since February 2025 on rising bets that the Fed will have to raise interest rates in the coming meetings to fight for its price stability. The Japanese 10-year yield, on the other hand, consolidates near the 2.75% level, which is near a multi-decade high, as well as the BOJ is also expected to normalize its rates to counter inflation in Japan, and same is true for the European economies. A benchmark for the European 10-year yield returned to the highest level since the Iranian war started, and rising oil prices pushed the benchmark yield to 3.20% level. And the positive pressure on the yields front will likely continue along with the positive pressure in energy prices, because note that the European nat gas futures jumped 4.82% in yesterday's trading session, and they're up by around 56% since their June dip. All that is obviously being reflected in rising government bond yields. So today, the European Central Bank is expected to announce no change to its rate policy, but Chief Christine Lagarde will likely leave the door open for another interest rate hike in the coming months if the geopolitical and macroeconomic situation deteriorates further. Interestingly though, the euro-dollar rebounded yesterday despite rising oil prices. That was curious, while cable saw a limited reaction to a set of softer than expected CPI read in the United Kingdom as traders look past the actual data, knowing that next CPI reading in the UK will look hot, if nothing, with a 13% increase in the energy cap in July. As such, the rising energy prices remain at the center stage and continue to boost hawkish central bank expectations. In the very immediate future, a hawkish tone today from the European Central Bank could eventually encourage a certain rise in the euro-dollar, but further down the road, if most major central banks, including the Fed, the European Central Bank, the Bank of England, the Bank of Japan, are all brought to hike the interest rates to fight inflation, the euro, sterling, and the Japanese yen will likely remain in a difficult position to bank on it. And the reason is that the growth outlooks in Europe and Japan are very much dull compared to the US growth outlook, because the US economy is benefiting largely from the AI and huge government spending. Therefore, any price advance in major pairs against the US dollar could see limited upside as long as the war in the Middle East and Ukraine drag on. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.